Welcome to AI Explains ICT. All right, let's get right into it. Today, we are tackling a concept that's, well, it's an absolute game changer in trading: fair valuation. And I'm not kidding. If you really get this, it's going to change how you see everything on the charts. Now, everything we're about to cover comes straight from the ICT mentorship, specifically the core content from month 1, episode 6. And look, the reason this is so crucial is because it's designed to do one thing: completely flip your perspective. We're talking about moving away from that typical retail thinking and starting to see the market through the eyes of the institution. So here's what we've got on deck. We'll kick things off with that new market perspective, dive into the 2 types of fair value, then we'll decode voids and gaps, look at the market maker's playbook, and wrap it all up with your new trading paradigm. Let's jump in. Okay, Section 1, a new market perspective. Before we even think about charts or specific setups, we have to tackle this foundational idea. It's a total paradigm shift, you know? It's all about making that jump from thinking like a retail trader to thinking like an institution. So let's start with a question you've probably asked yourself 1,000 times, right? Why does price really move the way it does? Is it all just random, chaotic noise, or is there something else going on under the surface? You know, the common retail view is that price movement is just chaos. It's random, it's just reacting to news, a total mess. But the ICT view, it's the complete opposite. It says price movement isn't random at all. It's engineered. It's deliberate. Think of it like a highly sophisticated algorithm that has 2 main jobs: seek out pools of liquidity and rebalance any inefficiencies it finds along. And that whole idea of engineering leads us straight to our main topic: fair value. But here's the twist, and this is super important. In the ICT world, fair value doesn't just mean one thing. It actually has 2 completely different meanings. One is about simple balance, but the other is all about opportunity. So on one side, you've got fair value as equilibrium. That's just the 50% level of a trading range, a point of balance where things are kind of neutral. But then, and this is the part you really need to grasp, you have fair value from the market maker's point of view. For them, it has nothing to do with balance. It's a strategic price. It's an opportunity to either load up on positions at a discount or unload them at a premium. Yeah, so let's just hammer this home. Equilibrium, it's that simple 50% midpoint of a range. Think of it as the neutral ground, you know? A consolidation spot where price could really go either way. It's perfectly balanced. All right, that's the theory. But how do we actually see this stuff on our charts? Well, we have to become detectives. We need to learn how to spot the footprints that the smart money leaves behind. And a lot of the time, those footprints look like voids and gaps. Okay, first up is what's called a liquidity void. Just imagine a sudden, super aggressive move in price. You see these huge one-sided candles just exploding in one direction. That explosive move creates a kind of vacuum, a major imbalance in price. And the market's underlying algorithm, it's basically programmed to remember that spot and want to return to it later to fill it in. And here's a perfect example on the chart. See that big highlighted area? That's a liquidity void. Price just absolutely fell off a cliff there, right? It's nothing but big, bearish candles. There was no real 2-sided trade happening. According to ICT, that big, empty space on the chart now becomes a powerful magnet. Price is going to be drawn back to it. Okay, now let's get even more precise. Inside that big liquidity void, we can often find something much more specific: a fair value gap. This is a very particular 3-candle pattern. It's a spot where price moved so fast that only one side of the market, either buying or selling, was available. The literal gap between the first and third candle, that's the real inefficiency we're hunting for. If we look back at our chart, that smaller shaded box inside the void, that's our fair value gap. It's the most inefficient slice of that entire price run. And that market algorithm we talked about, it sees that gap and basically gets a command: go back there. We need to offer trades on the other side of the market and rebalance that price. This right here, this is the market maker's target. So all of this, it leads us directly to the market maker's playbook. This is where we put all the pieces together. We take the ideas of discount, premium, and these fair value gaps, and suddenly we can see the whole game plan unfold, exactly how they see it. And really, the entire playbook can be boiled down to this one quote from ICT. It's so simple but so powerful. Fair value and discount is for market maker buying. Fair value and premium is for market maker selling. That's it. If you can burn that into your brain, you're starting to see the board from their side of the table. So here's how that playbook works step by step. First, they're patient. They wait for price to drop below equilibrium into a discount. Step 2, that's when they start to accumulate, buying up huge positions at prices that they consider fair value. Step 3, they engineer a run, pushing price up aggressively, often creating one of those liquidity voids we just talked about. And finally, step 4, distribution. They sell all those positions they bought low at a premium to all the retail traders who are now jumping in, chasing the momentum.
So after all that, what's the big takeaway for you? What does this actually change? It means you now have a brand new paradigm. You've got a new set of lenses, an institutional lens, to look at every single chart. From this moment forward,
Let's just wrap this all up into a few key takeaways. First, stop looking at the market like it's random. It's not. See it as an engineered system where price is deliberately sent from a discount to a premium and then back again. Your new job is to become a tracker, spotting those footprints, the voids and gaps that tell you where price is likely headed next. And remember, when you hear fair value, don't think balance, think opportunity for the market makers. Price isn't random. It is specific. It is deliberate. That is the new paradigm. Hey, if this video helped click things into place for you, please do us a huge favor. Hit that like button and definitely subscribe to the channel for more of these explainers. If you have any questions at all, just drop them in the comments below and a human representative will get back to you. Stay safe out there and safe trading.